G'day listeners and welcome to the APS Weekly News Bulletin, keeping you up to date and well informed on the Australian property market and what's happening in real time. Now guys, as you would have potentially picked up by this podcast going into it as well, we're talking about the Victorian market today. In one segment, we're going to be talking about Melbourne, and another segment, we're going to be talking about Greater Vic as well in general. So I've got two stories here relating to it. Now, story number one, guys, is Melbourne is now one of Australia's cheapest capitals. Here's why. Article by Arana Dernie-Benson from the REBs. From government policies to tax settings, a lot has been blamed for Victoria's housing slowdown, but the real story is much more complex. When the news dropped that Brisbane had overtaken Melbourne for median dwelling prices in June 24, it came as a shock to many Australians. Just 4 short years ago in 2020, the picture looked very different. At the onset of COVID in March 2020, Sydney had the highest median dwelling value, followed by Melbourne, the ACT, then Brisbane. Perth was ranked 7th in terms of median dwelling value, record Tim Laws, Research Director at CoreLogic Australia. Big Timmy. Fast forward to August 2024, and Melbourne's median dwelling value at $776,000 is ranked the 6th lowest across the 8 capital cities, so the 3rd cheapest in Australia. Laws said the difference between Sydney and Melbourne's median dwelling value is now 52.1%, the largest differential between Australia's 2 largest capitals since June 1999, so in 25 years. How did this change so drastically in just 4 years? According to Lawless, it started with COVID-19. Since the beginning of the pandemic, Australia saw marked differences in net interstate migration trends where strict extended social distancing restrictions were a push factor from Melbourne, while Brisbane, Perth and Adelaide likely benefited from Melbourne departures. At the same time, Australia's mid-sized capitals were coming off a prolonged period of comparatively slow housing growth. Housing affordability was far less stretched across the mid-sized capitals leading into the pandemic due to a prolonged period where values didn't rise anywhere near as much as Sydney and Melbourne over the previous growth cycle, said Big Timmy. Since 2020, steep and rapid price growth in Perth, Adelaide and Brisbane has been a key driving factor to shift the median dwelling value in the rankings. Perth has led the pace of gains with a stunning 76% rise in values since August 2019. Brisbane's up 71%, Adelaide's up by also just about 71%. In contrast, median dwelling values rose by 43% in Sydney and only 19.8% in Melbourne over the same period. In summary, guys, what we've seen here is obviously a prolonged period of very, very little to no growth in Victoria in general and in Melbourne, comparatively against even Sydney. It had a big cycle in 2013 to 2017. It grew again. It did the 43% in that 5-year window of COVID, or from just before COVID to where we are right now. And then you look at Perth, Brisbane, Adelaide, massive increases of 71% and above in that same timepiece as well. So whilst you've seen a softening, in that Victorian market and then a significant growth cycle in the others, you can see why it's ended up where it has. Now, there's a few things to consider here. And before we say that Melbourne is, yes, definitely the next best place to get into because it's now gone into a nice affordable point and all the rest of it, what I'm going to do first, I'm going to read out story number 2, and then I'll give a summary across them both, as it will give a bit of context as to what's happening in that market down there as well. Story number 2, investors flee Victorian rental market amid rising costs and new taxes. Article by Pippa, originally published by Rowan Crosby from Elite Agent. Property investors are abandoning the rental market in droves, with new data showing a significant increase in investment property sales over the past year. According to the 2024 Pippa Annual Investor Sentiment Survey, 14% of respondents sold at least one investment property in the past year, up from 12% last year. Pippa Chair Nicola McDougall said the majority of these properties are being purchased by homeowners rather than investors, further reducing the supply of rental properties. The survey found that 65% of former rental properties were bought by homeowners, with only 31% purchased by investors. So over 2/3 being bought by homeowners, which is a pretty big takeout there, guys. Rising holding costs and new property taxes are cited as the main reasons for investors exiting the market. Nearly 65% of investors who sold had owned their properties for less than 10 years, with 20% selling within 3 years of purchase. The top reasons for selling included increased general holding costs and compliance costs, 44%, increased land tax or government changes, 35%, and reducing total debt exposure was 33%. Ms. McDougall said the exodus of investors could lead to an even tighter rental market with fewer properties available for lease. The survey also found that investor sentiment had declined, with only 45% of respondents believing it was a good time to invest in residential property in Vic, down from 55% last year. Government interference in the rental market was cited as the biggest concern for investors, with 87% of respondents identifying it as a potential threat to their investment strategy. Ms. McDougall called on governments to reconsider their approach to rental reforms and property taxes, warning that continued intervention could further exacerbate the rental crisis. Continuing with this as well, when asked what the biggest challenges or concerns were that might derail their property investment strategy, whopping 87% again said it was a government interference in the rental market, such as regulation, rental caps, or rent freezes. The continuing change of the goalpost by various levels of government, masquerading as tenant-friendly policies, is continuing to negatively impact property investment sentiment as well as rental housing supply. Now, obviously, guys, like the last few lines of that article there were a general consensus of the overall market in Australia and rental market and investment policies in Australia. But the general consensus of this article relating to Victoria is that there's a lot of people tapping out and actually moving out of the rental market as investors, and then also, obviously, which is creating a tightening of the housing market, right, from a rental supply perspective. Now, that's obviously good from a rental perspective if you're an owner and you're a landlord and you're renting the property out. But the fact still remains that people are driving it out for a specific reason. When you throw in some big changes that have come in the last 12 months, we had the land tax reforms. 12 months before that, we had the big rental reforms. Now, in those big rental reforms, a lot of things changed, like compliance, a lot of compliance changes and things like that as well. So when things were coming up for release, if properties weren't compliant, rather than going through the lengthy and costly expense of getting those properties compliant, a lot of people were tapping out and just been taking them to market. And as you can see here, they're being bought up by 2/3 homeowners as well, and only a very small portion of investors have been buying that stock back up. Look, as an overall summary in the Vic market as well, guys, there's a few things we've got to obviously consider here. It is becoming the most affordable market, or it's third cheapest market in Australia right now, which is a pretty impressive thing to sort of be, considering the size of the city. Melbourne is a 5 million plus population city. However, it is very spread out, and it also has a dense population of units as well. So whilst we throw all that into the mix, even though it is, very affordable for kind of what it looks like or what it seems at the moment, there's a few constraints there that I think are really going to kind of hamstring growth in the short term. I think medium to long term, I believe Melbourne probably will actually be quite a good play, but are there better locations to be investing in right now that's going to give you a better return over the next 6, 12, 24 months? And the answer, I believe quite strongly, is yes. There is still negative sentiment down there. There's still a lot of people exiting the market, cashing out. A lot of markets are still really flat, a lot of stock. There's a lot that's going to need to change before those markets start to go through a pretty good run, a pretty good growth cycle as well. So I don't think it's a bad medium to longer term play, but are there better opportunities right now to make more money in the next 6, 12, 24 months in your portfolio? The answer, I believe, is a resounding yes. Guys, I hope you took some great value out of that episode, and obviously the dissection of the Victorian market and a couple of articles explaining around that as well. If you did, please send it on to someone else that you think could also benefit from listening to this episode. Maybe you know someone that owns property in Vic, or they've been talking about Vic or whatever. Maybe you could send this on and give them a bit of clarity as to what we're seeing happening out there in the market as well. But other than that, guys, until next week, I'll leave you to it, and that's another APS Weekly News Bulletin on the Scouting Australia podcast.